All right, great. I think we're just about leveling out on our participants. So welcome, everyone. My name is Kirsten Loita of Osage University Partners. Today, we are bringing you yet again our annual discussion on startup financing trends to understand current market behaviors among startups. We do use these webinars as a great opportunity for our partner institutions, technology transfer offices to ask us questions in real time that they may have on startup financing trends of particular industry sectors. And we have two of our OUP investment people joining us today to cover those sectors, Margalit, Haber, and Manny Stockman. I'm going to have them introduce themselves, and then we'll go into more of the webinar. Margalit, do you want to start us off?
Sure. Hi, everyone. So my name is Margalit Haber. I'm an associate on the life science investment team here at OUP. My background is I have a PhD in neurobiology, spent some time doing preclinical and clinical work, potential therapeutics, prognostic biomarkers, and a bit of neuroimaging for neurodegenerative indication, and then jumped over from the bench to industry. Spent a bit of time in life science, startup and biotech community in Philadelphia, and joined OUP in September of 2019, so almost 2 years now.
Terrific. Margalit, we're so glad you're with us and that you're here today. Manny.
Yeah, thanks, Kirsten. Thanks, Margalit. So I'm Manny Stockman. For those of you who I've not met before, thanks for joining. My background is in applied physics and aerospace engineering. After grad school, I went to Lockheed Martin for 6 years, which I'm just now reminded of talking to Kirsten before this call that I've now been at Osage this month as long as I was in my last job. So it's been great working with many of you all on the team here. I'm a principal on the investment team on the tech side. And we invest across a broad swath of things, ranging from semiconductors and photonics to materials and robotics and enterprise software.
Great. Well, welcome both. We're so glad to have you here. And we did want to thank a couple of other of our team members. We wanted to thank our colleague Nabil Ullah, who helped create a lot of these slides, and also our intern Bethany Chen, who also helped particularly on the life science part of the slides. So thanks you guys so much for helping us put this data together. Today's topics, Margalit will be running us through life science trends. Then Manny will be doing the tech trends as well. We'll also be talking about trends in IPOs and SPACs, and then have a wrap-up summary. With that, just a little bit more information about this webinar. We're not going to have a dedicated Q&A period. We encourage people to just ask their questions along the way. I'll moderate those and ask them of the panelists, or as they see them, they'll answer them as well. But we do encourage Q&A throughout the webinar. We think it keeps it interesting for everybody. So use that Q&A box. We typically like you to use that rather than the chat box, just because we can track things a lot better in the Q&A feature. We are, of course, recording this webinar as we do with all of our webinars, and this recording will be available on our OUP partner portal afterwards for our tech transfer folks. We're also hopefully going to create a version of this for other researchers at the academic institutions in the future, but currently this is just a resource for our tech transfer folks. But you can also see a recording of this webinar on our YouTube channel as well. So we'll send out that recording to everyone after the webinar itself. So with that, and we'll also be sending all of you the presentation deck. I forgot that. So we'll send you this deck afterwards too. So don't feel like you have to take really detailed notes, because we will send this to you afterwards. So with that, I'm going to have Margalit start us off with reviewing last year's life science investment trends. Margalit.
Great, thanks, Kirsten. So we generally start with an overview of sort of the whole life science sector. I wanted to note that the data we will show you throughout the presentation is a combination of external and internal data. For the life science section, many of the slides, like the one on your screen now, will have data pulled from the Silicon Valley Bank report on healthcare investments and exits for the past year. We use this report because it's an excellent resource. You can get a copy of it yourself by going to their website, just entering in a few pieces of information. It's free to download. So the graph on this slide covers all areas of healthcare and life science companies for the past 3 years. It's divided up by quarter. What you can see is there was this large uptick in the capital deployed and number of deals done in 2020, particularly in the third quarter. So while the number of deals done were hovering around 300 per quarter from 2018 to 2019, in 2020, we saw this jump up to 400 plus deals and an almost doubling in capital deployed, specifically in like the Q3 of 2020. This increase was seen in every area of life science investments, biopharma and therapeutics companies still taking the largest piece of the capital deployed. However, that's followed by health tech, diagnostics and tools, and then devices. So you can move to the next slide. So we're going to dig a bit more into each area of healthcare, starting with biopharma and therapeutics. So the data on this slide focuses on university spinouts specifically. We have an internal database of around 15,000 university startups, all active, dead, and acquired. We've been tracking these startups over the course of the existence of OUP. A good chunk of that data comes directly from our university partners, and I'd like to thank our partners for providing us with that information. And the rest of the info comes from areas of our network, the internet, direct follow-ups with companies, and so on and so forth. What we did is we pulled all the startups from our internal database that are linked to a university and categorized them according to the area and sector that they're in, and then pulled the financing information for those companies from PitchBook. The companies on this slide are all therapeutic startups that are linked to a university. So some of the upward growth you're seeing in the graph is the result of us adding more universities to our network and having more startup data to work from. However, the last few years are pretty stable with regards to the number of universities in our network. And you can see that there is an increase in amount of capital being deployed into university-derived startups, jumping from 7.2 billion in 2019 to 8.6 billion in 2020. Interestingly, the number of deals dropped from 2019 to 2020, which matches the trend we saw of more dollars going into fewer deals and much larger financings happening because of that. The first quarter of 2021 has shown a record number of activity, which has sustained itself for the remainder of the year so far. And if it did sustain for the rest of the year, it would project out to about $12 billion. We are starting to see some slowing down though, and a little bit of softening in the market currently. So whether that will be sustained or not is within question. Next slide. So going back to the Silicon Valley Bank data, if you look at the first graph on the top left of the slide, it depicts the number of deals and total dollars for the therapeutics and biopharma sector overall. Biopharma investment was up in 2020, hitting a record $24 billion in capital deployed compared to last year's $16 billion. Just like in previous years, oncology remains the area with the largest interest. However, platforms are also an area of heavy investment as well. The graph covering all financing shows us where the money is going overall, but the Series A financing graph on the bottom gives us a better sense of where funds for early investments are going. And you can see neurology and CNS is an area that many investors have historically in the past have been kind of hot and cold over, but over the last year, we saw a large increase in neurology Series A capital. There's about a six-fold increase in neurology Series A dollars, going from 150 million in 2019 to 930 million in 2020, possibly indicating sort of more confidence coming back to the neurology sector. Okay, next slide. So regarding areas
Actually, sorry, we do have a question. So and I was on mute, of course. Margalit, we did a question. I'm sorry if you were going to ask that. It says that we were seeing a slowdown as well. What do you attribute that to?
Yeah, I think there was, it's a little hard to say, but there was a lot of very large financings happening with very high valuations. And I'm starting to get the sense that people are getting a little bit more price sensitive and trying to get a little bit more comfortable with what market value actually should be for some of these financings. We'll talk about it a little later, but a lot of companies were utilizing the public market to raise, and by doing that, they were getting really high valuations and high market caps, raising a lot of capital, and that sort of pushed the valuations up a lot. And so I think people are starting to get a little bit more, just a little more price sensitive when it comes to what the valuations of these companies are, and stepping back a little bit to say, like, what should the valuations be? Where should these companies be? And how much should they really be raising?
Great. And then we had another question about that one of our audience members is seeing a more platform focused and aversion to individual assets with regards to the startups. Are we seeing that as well?
Yeah, so there it's really dependent on the fund that's looking at the particular company. Some funds are prefer platforms and won't touch any company that has a single asset. Other funds are more comfortable with single asset types of investments. The reason platforms are more popular is because it just if actually, Kirsten, if you go to the next slide, I talk a little bit about this. So platforms provide multiple shots on goal. So it just allows for like just a much more de-risked type of investment. And so if one asset fails, you have 3-4 more programs following it up or in other indications that are going to sort of make up for that. So that's why you see like a lot of VCs kind of prefer platforms. And they're also willing to take sort of earlier bets on platforms for that reason. However, there are other companies that are just more willing to take individual asset investments. It's on other funds that are willing to take individual asset investments. What you're doing is with the individual asset, it's more of a binary risk. Either it works or it doesn't work, but you could be more capital efficient with it as well. So it really is just dependent on the fund itself. But again, so like platforms provide multiple shots on goal. They are still of interest to a lot of investors right now. What we're seeing a lot of interest in particular for platforms is high throughput screens and any platforms that sort of utilize AI and machine learning to sort of get to novel targets or improve drug discovery and so on and so forth in a much more expedited way. We also are seeing a lot of people just really interested in terms of novel target discovery using AI and machine learning. The targets they look at tend to be more interesting if they have some sort of human genetic validation. When it comes to these very early novel targets, target validation is really key. The other area that continues to be attractive to investors is oncology. Oncology is always interesting because there's just still such an massive unmet need, and the safety and efficacy bars are very different than for other indications. A lot of oncology therapeutics don't work and are only marginally work. So the focus again is on genetically validated targets. So there is an interest in novel mechanisms of action, but whether a fund is willing to take sort of the biology risk is fund dependent. And then there's a lot of discussions around patient selection strategies for these therapeutics as well. I think we all understand that many compounds are failing because they're not going into the right patient subsets. So having a way to select the right patients with the right predictive biomarkers is key. Neurology is an area where there was traditionally a lot of biology risk taken. I think with the renewed interest in the CNS, there is a reluctancy to take that biology risk now. So for neuro, again, there's a focus on genetically defined targets, like some of the neuro-orphan rare indications. There is a lot of interest in neuroinflammation and drugs that directly target neuroinflammatory cells, as well as regenerative therapies. The idea being that these mechanisms can be applicable to multiple neurodegenerative diseases. And again, we're seeing efforts to co-develop biomarkers with these therapeutics to pick the right patients and give indications as to whether these therapies are working in these patients. So like a biomarker company in itself isn't always the most interesting, but a therapeutic company with an available biomarker is very attractive. Cell and gene therapy continues to be attractive to investors. There seems to be continued interest in CAR and TCR T-cell approaches that are more innovative. And we're also seeing investments in vivo cell programming approaches, like in vivo CAR T-cell approaches. With approaches like these comes the need for better delivery tools. So while drug delivery was more or less overlooked a little in the past, there's been a renewed interest in non-viral delivery approaches that can specifically handle some of these gene editing and cell modifying tools. Rare and orphan disease is still of interest, as well as autoimmune therapeutics too. And then with regards to areas with a little less investor interest, similar to last year, IO antibodies have had some difficulties. Similar to last year, there's a lot of competition, few success stories. It makes some investors weary. And the larger fibrosis areas like NASH and IPF have become a difficult space for investors as well. Again, there's a tendency to prefer diseases with genetically defined targets that can be drugged or very well-defined mechanisms of action for pharmacodynamic biomarkers to help sort of de-risk the investment. And areas like NASH have trouble finding drugs that fit that mold. Go to the next slide. Okay, so now we're going to switch topics a little bit, and we're going to go and look at the device sector of investor activity right now. So we pulled device startups from our university database and looked at the financing activities that we were seeing over the last few years in the university device sector. You'll notice this chart is very different than the therapeutics graph. There is a lot less investor activity in devices, fewer deals and less capital deployed. While the therapeutics saw a steady increase, the devices show more or less equivalent activity since 2017, sort of hovering around 1 billion for total capital invested. Next slide. So when you look at the sector as a whole, there was a small increase in capital deployed into devices from 4.8 billion in 2019 to 5.4 billion in 2020. And if you look back at 2017, there's this steady increase in device investing. So it is going up. Looking across focus area though, neurology led a number of deals, but just barely over imaging and non-invasive monitoring. So they're all sort of equal interest. Non-invasive monitoring pulled in the most capital with 712 million. When focusing in on the early stage deals though, on the graph on the bottom, Series A activity, there is a continued decline in Series A investments. This is something we saw last year, that the number of deals and dollars deployed were falling for all device areas, and we're seeing that pattern continue this in 2020 as well. So steady increase in total investment is related to more capital going into later stage deals. Next slide. This slide covers who is investing in the device space, and you'll notice the lack of sort of traditional life science venture funds. However, there are groups more med tech focused, groups like Shanghai Capital doing the most device deals last year, and angel groups like the Tech Coast Angels also investing in early devices. Corporates are still interested in devices. We know J&J Innovations is always looking for device investments. And then something we've seen on the therapeutic side last year was crossover funds looking at earlier stage assets, since more early stage therapeutics companies were going public. However, that trend has not translated as well into the device area. There is still crossover activity in devices, but they are still all focused on sort of later stage companies. Okay, next slide. So last year, we saw a lot of companies going public, and we'll talk about that in a bit more detail later in the presentation. However, that trend has translated over to device companies to some extent. On the top graph on the left, you can see the number of IPOs for devices went up from 8 in 2019 to 11 in 2020. So there was a small increase. And then if you look at the graph on the bottom, on the left-hand panel, the market cap at IPO has steadily increased over the last year, taking over the majority of that $14 billion exit value for 2020. This is also translated to decreasing time to exit for devices. So on the chart on the right, time to exit for devices was typically around 7 to 8 years, which was one of the factors making device investments challenging for VCs. But last year saw a time to exit closer to 5 years, which is sort of a result of this using the public markets to raise capital and becoming a public company, which is a better time frame for the VC investment model. This shorter time to exit, this could also attract some more venture interest into the sector. It's also noted that this could possibly convince acquirers to purchase device companies earlier before the IPO to sort of keep the values below whatever the market cap for that company would be public, and that would keep time to exits down as well. Okay, next slide. So now we'll look more closely at the diagnostic space. For university diagnostic spinouts, we saw an increase in capital deployed to diagnostic spinouts in 2019 to 2020, while deal total kind of hovered around the same mark. This hints that more capital is going into those deals, and that is why that is also what we're seeing in the sector overall as well. Next slide. So the Silicon Valley Bank report kind of groups diagnostics and research tools together. So that's what we'll talk about in the next couple slides. The diagnostics and tools sector saw a very large increase in capital invested, doubling from 5.4 billion in 2019 to 9.6 billion in 2020. So every category in the sector saw an increase, with R&D tools really seeing the largest increase, doubling to like a $4.1 billion invested total. There were $1,300 million deals, the majority of which were for AI and machine learning drug discovery platforms. Diagnostic analytics and tests also saw an increase in capital, mainly driven by a select number of deals, however. So in diagnostic tests, it was really early cancer detection deals that drove the increase. This the raises by Grail, Thrive, and Freenome. There was also an increase in investment in anti-infective and platform companies that pursued COVID-19 tests. I know we saw a large number of these companies in the university sector sort of pivot to COVID-19, and those companies were able to take advantage of some of the capital available as well. So while this, yeah.
I was just going to say, we did have a question on that, and I think you kind of just answered it. The question was, what % of the increase in diagnostics, financing is due to COVID? But I don't know if we know the exact number, but that you did see, obviously we did see an increase in that, particularly for the anti-infectives.
Yeah, I don't have an exact number. We can maybe try to pull some data and see if we can get one. But it did contribute. Yeah, it wasn't the largest contributor, but it did contribute.
Yeah, definitely. And we have, just FYI, we do have a couple of other questions for you, Margalit, but we'll get to those after these slides. And I just did want to let our audience know, if you raised your hand, if you could write your question in the Q&A part, that would actually help us order things. So go ahead. Sorry. Okay. Do you want me to go to the next slide, Margalit?
Oh, no, let me just talk about the graph on the bottom. Okay. So while we saw just this increase in the sector as a whole, Series A investments actually were mostly flat, with increases and decreases sort of falling into the noise of the data for the most part. So for R&D tools and analytics, the largest deals were really like AI and machine learning enabled research tools and analytic platforms. For diagnostic tests, there were 3 or so the largest deals. One was a blood-based Alzheimer's test, another was blood-based cancer test, and the other is a point-of-care COVID-19 respiratory infection test. So that was a contributor for the early stage deals, was a COVID-19 test. Okay, next slide. So with regard to the investors that are active in the diagnostics and tools space, it's a bit of a mix, but you can see a lot more traditional tech investors in this space, with North Pond and 8VC sort of topping the list. For corporates, Agilent and Alexandria top the list with most investments, followed by other familiar names like Illumina and LabCorp. And this year saw an increasing crossover investment in this sector, actually. So consistent with the later stage, larger deal size investing increase that we saw in this sector, and that the sector experienced. Okay, and then go to the next slide. So what we saw in terms of the exits for diagnostics is there was some IPO activity, but the majority of the increase in exits was sort of driven by more merger and acquisitions. So there were, and they were mostly driven by sort of a select number of deals. There were sort of a record $1 billion plus market caps at IPO though, or private M&A deals. And again, they're mostly for AI and machine learning enabled platforms. There was a sense that these platforms would sort of provide good investor returns for a while, and there was money getting deployed into these deals. And 2020 really was the year that these deals saw a return for investors. And then diagnostic tool M&A by median value on the right. So another concern for investors in the diagnostic and tool space is also like time to exit. And then also the deal size itself. And you can see for 2020, actually, there was a good size on the deal. There were a median deal size was up as well, and the time to exit was low, hopefully indicating that this might be a space that would attract more venture investment in the future. Okay, and then, so that kind of wraps up the life science section. Yeah, if there are any questions, Kirsten.
There are. So there are a couple of questions, although I think we might address this in the IPO and SPAC part, but I'm going to ask them now since they were asked. So, one person wrote in that there was really interesting trends regarding the use of public markets to raise capital in therapeutics. What's the downside of that strategy, and can this create a backlash for the industry compared to raising private capital, especially, as some of these therapies being tested are going to fail?
Yeah, we always talk about going public is actually pretty expensive, and not the easiest process. And so being a public company is very different than being a private company. You have to do a lot more reporting. You have to, there's a whole infrastructure you need to set up to accommodate public company activities. So it's not ideal for every company. Sometimes it's easier to stay private and raise private funds. However, there was so much available capital, it just became such a nice route for these companies to really accelerate their businesses quickly and raise that capital quickly. Yeah, and then the downside is, yeah, once these companies are public and therapeutics fail, stock prices drop, public markets are volatile. There's, the whole process of raising private funds is very different than what happens once these companies are public. And so it could backfire on some of these companies going forward. And it could also, in terms of a strategy for these companies, when VCs are sort of assessing the companies, it's one thing that we make note of, and we're paying attention to what the trends are in the public market. And if that is a route that company wants to take, we are going to make sure that we are benchmarking it against the other companies that have gone public there. So we will be keeping a close eye on it. I think that it's really, whether it's bad or not, time will tell in a sense. We do think that the market's sort of softening, so there might be a little bit of a drop in valuations, but hopefully some of the valuations will stay consistent. But we'll see. It's more of a time will tell kind of thing at this point.
Right. And I'm sure we're going to talk about this more in a few slides as well. So, but it's been an amazing time, especially on the therapeutic side of the IPO market. So
I will say it's been great for investors though. Recently.
Great for investors. And for the universities and their stock holdings too. So it looks like SPACs started picking up in the biotech and pharma sector this year. Do you have any insights into how popular this is approach versus traditional IPO? And again, we might be talking about this in a few slides, but I'm going to bring it up since the question was asked.
Yeah. So for life science companies, IPO was the preferred route. There was more capital available if you went through if you did an IPO. SPACs were the less preferred route, but there were a number of life science companies that did go through a SPAC to become public. And then on the tech side, we saw a little bit of a different trend. If you want to talk to that, Manny, a little bit now.
Yeah, and it was interesting we'll go in deeper into SPACs in a few slides. But I think the difference between the tech and the life science side was there was a consistent trend of life science biotechs going public with zero revenue. And so the trend in the SPAC world that favored physical sciences, tech companies going to de-SPAC with zero revenue made sense, because historically that window was only open, the window to being public was only open to companies generating tens of millions, if not over $100 million in revenue. So the SPAC world for the biotech side is still nascent, and it's not quite clear why they would, but it has happened.
All right, with that, Manny, we'll move on to you.
Yeah, great. So I'm happy to report that the general overall tech investment trend for the year of 2020 was a surprising uptick. I think when we all were preparing for COVID in the tech industry amongst many VCs, as you all may have heard from us in the past, we assumed it was going to be carnage, and that's because business discussions would decrease. Companies that needed to physically work together we're going to have a hard time getting in the lab. But I'd say across our portfolio of companies and the companies we spoke to, many companies saw a boom in their productivity, and some companies even saw a boom in their revenue. And what happened in the venture investing landscape, and what you're seeing here in the top right, is an overview of broadly speaking tech venture capital, was that 2020 was an all-time high. And if you actually were to break down 2020 by quarter, you'd see a strong dip in Q2 and somewhat in Q3 of 2020 as well, which implies that Q3, Q4 was just an absolute, crazy time to be an investor. And there was a lot of deals that were going on, very much a year where investors put money into their own portfolio, but also in brand new investments in a larger average deal size than usual as well. So the total dollars increased for 2020, but the number of deals decreased. And so we saw very large investment rounds, primarily in established companies. I'll talk about the seed stage in a little bit, but a lot of the investments were put into Series A and Series B and Series C stage companies, and that increased the deal size. So the other thing we often look at is the percentage of deals by size. And in the bottom right, you'll see a trend over the past 10 years where the average, the percentage of deals that are happening in any given year is trending less in favor of smaller angel seed rounds and more in favor of larger check sizes. And so the 2020 timeframe saw roughly 25% of the deals were in the $0 to $1 million range, and a very large number of deals in the $10 to $25 million or above range. And so all this points to more venture dollars on the market, larger funds growing, seed angel funds turning into Series A funds. We're sensing that, and that's what some of this data reflects. However, I should say it's not, there's still overall more dollars in the market available. This is really just by percent of deals. So the dollars are still available. And we'll, on the next slide, Kirsten, if you can jump into that, this is more of a reflection of what's going on in the angel and seed stage. So 2020 was, notably an increase in the total dollars deployed into angel and seed rounds, which is relevant to universities because you all are dealing with companies at this very nascent stage where they need to track down their first $1 million or $2 million. And the total available capital is there. And you're seeing new funds pop up all the time. You're also seeing some very large funds move into seed investments because they want to increase their ownership of companies at the earliest days. And the other thing to mention, though, is the overall deal count at this stage is going down. And that points to, as I mentioned before, a larger average first financing check size. And it's not obvious to me in reading that if the seed capital is harder to access, or if it's that companies just need to ask for more dollars and present a bigger, more thought out vision when they're going to raise from institutional VC. And so I definitely encourage you all as you work with your startups to really think about what's the $1 to $4 million seed round, maybe $2 to $5 million seed round versus the $1 million seed round, because that may resonate more with investors that now have a larger purse to spend on their rounds. So we can jump to the next slide. And this is a breakdown of the information, the data you saw in the slide two above, which is overall venture investment activity, but by sector. And this is not specific to university spinouts. I'll get into that in a little bit. But this is very focused on where the money is going by sectors that are relevant to the university space. And there's no surprise. I think everyone knows software dominates in the tech industry. And there was $74 billion of venture capital invested into software, up from $58 billion in 2019. And this is what dominates in the investment industry. And it's because historically the returns have been there, the exits have been there, and not to mention COVID in 2020 was definitively a boom for many types of enterprise software. However, there's an overall increase in physical sciences dating back from a few years ago. 2019 to 2020 was flat for physical sciences, but there's been an increase in the general trends over the past several years, but also in healthcare. And healthcare, as for the tech perspective, is primarily capturing here the data we pull from PitchBook is healthcare IT, some of the AI, ML for drug discovery type healthcare applications. It's not including biotech, and it's not including devices or diagnostics. The other category is kind of a catch-all for things like transportation, fintech, some areas that are just relevant to the overall tech industry. So I think the other thing I want to point out is in 2021, this is already looking to be a pretty significant uptick, much like it was for the life science side, where the 2021 pace is very rapidly showing that it's going to eclipse 2020 if it continues at this rate. And so it's another banner year for the overall industry. On the bottom right, this data is not that interesting at the first look because it's kind of flat overall for 2020. The overall median deal size is not changing. And when you really look at this data, though, if you were to dive in and look at the raw numbers, you would see that the averages are much greater than the medians. which means that there's a select group of companies that are raising tremendously sized rounds, like 100, $200 million rounds at very high valuations that would actually bring up the skew of the average. So it's hard to present this all in one slide, but really the highest performing companies are capturing some high valuations. And if you look at 2021, we're starting to see an overall increase in the deal size of the median deal size. It's still a little early to tell what's going on here, I think personally, but I am surprised to see that, for instance, the average deal size, the median deal size for early stage is up from 6 to 8.5, and at the late stage up from 10 to 17. So I think these are things we'll watch this year to see how it relates. Any questions we should hit, Kirsten? Okay.
Not so far.
So.
Oh, actually, I apologize.
Yeah.
So there was one that just came in. With the increase in size of the seed rounds, is this distinction between seed round and Series A blurring? If so, potentially this could have ramifications on how anti-dilution provisions should be structured.
Right. Yeah, I think there's definitely it's a good question. And some of this gets into the nuances of how we've seen a lot of variability in how anti-dilution is written. I think it's safe to assume that seed rounds are going to be larger over time. And in the next couple of years, they will continue to increase in size. And so as we've always suggested, the language should be more reflective of a quantitative number versus a term. Like, we have historically seen things written as first round of financing. We always suggest that the tech transfer offices try and put a hard number in there. So it's, anti-dilution through the first $7 million of venture, of financing or equity dollars raised. And that just puts a hard number that I think will give you some level of being agnostic to whether the round is increasing in size or not. What does happen when you raise a larger round, though, is the valuation of that round is typically reflective of that. So I think those are you might see more dilution, but hopefully the anti-dilution clause protects you against all of that. So moving on to this next slide, this is one of my favorite things to do with our data. I love the data that we sit on at OUP that's shared with us from your offices, because we are effectively the world's strongest database of university spinouts. And so we have over probably 12,000 alive, active, and dead companies in our database. What I've done here is take just the tech industry, the tech startups that have spun out of universities in our database, and looked at their historical dollars raised by year. And so this is, broadly speaking, university tech spinouts, as Margalit showed for some of the sectors that her team looks at. And just seeing the dramatic increase in venture dollars deployed into university spinouts is dramatic. Like, it's been, since I've been here at OUP since 2015, it's been a steady uptick year over year, where 2020, however, was flat. And that was something that I think is, I'll get into on the next slide. But it's, unsurprising that some of go back to that previous slide though. The overall deal pace was down, number of deals decreased. However, it was still a large amount of dollars. The general feel I have of university spinouts is that these are the hard tech companies. They're the ones that had to be in the lab, many of them. And so they were the ones that didn't necessarily capture the most funding in 2020. And they were the ones where investors were hesitant to invest during COVID. What we're seeing in 2021 is a much more significant uptick in investment activity than I would have expected. As in the previous slides I described, 2021 is looking to be a banner year for venture capital. The pace of 2021 for university spinouts in tech seems to be much larger, in proportion to the overall increase in tech investing. And so I've asked Nabil to triple check this data, because I didn't believe that we'd already deployed $9 billion into the university tech industry in 2021, but the data does support it. And so it's showing that I think more investors are coming into the general category of university spinouts, which I think we should all be excited about. On the next slide, this is where I wanted to break down and kind of juxtapose the university tech investment activity by sector. And as you remember from previous few slides, a lot of the dollars in general venture capital in the tech industry go into software. It's not the same when you look at the breakdown by sector of university startups. And unsurprisingly, the physical sciences is the dominant investment sector for VCs putting money into the spin-out space. And the categories here map to the ones of the previous slide, where software is enterprise software primarily. Physical sciences is kind of everything else in the tech world of materials, robotics, semiconductors, energy, healthcare is healthcare IT, and other is kind of a catch-all. And the trends that we've seen are similar to what happened in the general venture community, where 2021 was an increase in investments in spin-outs and software, and there was a decrease in the overall physical sciences industry. So I think those are all predicted and expected. And what we've done for the first time this year, I think, is this plot on the bottom right, which is looking at the percentage, so by sector, looking at the percentage of investments in university spinouts as a percentage of total dollars deployed in that sector. And so, unsurprisingly, physical sciences is the highest. What was a surprise was that it's 21% of all venture dollars deployed in the physical sciences industry are in university spinouts. You compare that to software, which is in the university world, 4% of all dollars in software VC go to university spinouts. It's pretty amazing to see this juxtaposition of just how exciting the physical sciences industry is in coming out of university. So I think this is a trend that's going to continue as the world's moving more to deep tech and less to consumer software and apps that have been a part of the investment activity world for the past 10 years. Why don't we jump to the next slide? So, getting into the areas that we're seeing at OUP as active areas for investment that have captured most of the interest of the tech industry for now. And I'd say it's been a pretty rapidly evolving space. Margalit pointed out something that I think was really interesting on one of her last slides, where biotech investors are now starting to pay attention to AI/ML and where you can start to generate high throughput data for drug discovery. And there's been a really exciting convergence of their viewpoint, which was somewhat skeptical early on, and the tech viewpoint, which was very bullish early on, and then a meeting in the middle, which has been interesting, where early on the tech industry thought AI and software for drug discovery should be about selling software, and the life science community said there's not enough value creating that, you've got to develop the drugs. And now we're starting to see the most interesting life science companies that are building or have software as a tool going after a pipeline of targets. And so as you all work with your startups, definitely think about how to have them build that story of maybe not today, but within a year or 2 or 3 years, having a path to a pipeline of drug candidates is something I think will resonate with where the overall investment activity is in software for life sciences. As always, in the enterprise software space, cloud computing is an important area for investment. Infrastructure has always been a very productive area out of universities. And the thing I'll mention that's interesting to a few of us is orchestration. So as you start to get into this heterogeneous computing world, how do you start to decide which parts of your compute go to which specific silicon resource is something that I think is going to be important. And then, there's also a growth that we're trying to sort through the noise of AI and ML tools. It's clear, machine learning is going to be a part of enterprise software. And what's unclear is, what does the data scientists and engineering teams need to have at their hands to be most effective at deploying it? There's companies that are trying to come up with very specific niche things that they can improve on. Maybe it's the inference component, or a new language for programming data science, or maybe it's the whole stack. And it's actually just a really noisy space that we have a hard time sorting through, but investors are paying attention to it. In the cybersecurity world, secure computing is going to be very important. We're starting to see new modes of hardware that are there to protect data and allow confidential computing to occur. And also this kind of growing world of data compliance. How do you know when and where your data is being operated on and used is something that I think startups are starting to build around. On the right side, next generation computing, I'd say there's still room for growth in accelerators and photonics, and specifically the combination of those two. And on the quantum computing front, I think it's still early days as to which hardware will win, I think it's also still too early to build software for them. So I think there's just general interest in quantum computing, but also I'd say quantum information sciences. So possibly people are going to be looking at quantum key to QKD and quantum networking as things that maybe have a derivative development to build off of the successes in quantum computing. The last thing I'll hit is on just energy and clean tech. We're in something of a renaissance right now in clean tech. I don't know exactly how to describe what's happening, but there's a significant number of investors that are excited about revisiting how they can generate returns on sustainability and environmental plays. That's somewhat driven by the ESG movement from major corporations that want to be carbon neutral or net negative or net zero. And it's been a collision of investor interest in deep tech and corporate interest in possibly spending money on products that aren't necessarily aren't necessarily profitable, or maybe they're more expensive because it helps their net zero story. And so there's been a number of investments in this space, but I'd say generally it's in new categories of products. People don't want to reinvest in solar. Batteries are still not exactly back in vogue, but if you start to have a different approach to deployment in the market for your battery, investors will take a look. I'd say it's more in new forms of sustainability, whether it's CO2 sequestration in concrete or direct air capture, are the things that people are looking at. In areas of reduced excitement, I'd just say AR and VR really seems to be not necessarily dead, but consolidated, where there's only a few major players that are really building out, and it's Facebook and Apple. And it's kind of like good luck getting penetrated there from a customer perspective. And so it's been a big hesitation to invest in that space. IoT, it's not that the technologies are not exciting in IoT, it's that the major use case has always been in industrial IoT, and how you end up closing customer opportunities in that space has proven to be really difficult because those customers just haven't really understood the value creation, the value proposition, or been able to show the value propositions there. So those are areas that we think are cooling off, and I'm happy to talk offline about any of these with anyone in the audience. So similar, the other thing I think is really interesting about our data is we can go in and look at all the university startups and the tech industry and say, who are the most active investors in this space? And I think this slide has carrying away value, so I won't go into it too significantly. I think, on the left, you have the incubators and seed investors that are very active in university spinouts. Berkeley Skydeck has been a great place for university startups to go beyond just the Berkeley ecosystem. They're bringing in startups that are outside the university. And then in the early stage VC space, you have all the big names are active in this space. And what I tried to do this year, what we tried to do in our data was pull out all the way on the right, the non-software investors, just so you all in the categories that matter, not the ones that garner most of the interest in, which is software. It's like the physical sciences, the energy, the clean tech, the semiconductor, who are the most active investors. And so this is a ranking of the most active investors in those categories that if you all would like to reach out to them, let me know, and maybe I can provide an introduction, but you should feel free to reach out to them because they're obviously looking in this space. I think that's it for the tech section. It's mostly what I wanted to cover. Margalit will then take you into some of the life science IPOs, so I'll let her take it from here.
Great, thanks, Manny. Kirsten, do we want to cover that one question from previously about life science trends? And
sure, yeah, if you have a response to it, and I'll just ask the question, which was about typical round sizes in biopharma for pre-seed, seed, and Series A, or some of the other areas that you covered, Margalit.
Yeah, so apologies on getting to this question. We were actually pulling some PitchBook data just to confirm some of the means. And so for biopharma and therapeutics, there's actually the pre-seed and angel type rounds. They kind of hover around like 2 million for seed. We've seen as low as 500K, I'd say, for sort of a pre-seed, get some de-risk preclinical data. And 2 million to like 5 million possibly. For a seed round, could be anywhere in the range from like 5 to 10 million, depending on what the capital required is for that particular device or stage, or mostly for therapeutics for that particular therapeutic. The mean that we're seeing is close to close to 5, but for some of the university startups, when we pulled that data from PitchBook, we were seeing in 2021, there's been some seed rounds where the mean really for that pool of data is closer to $8 million. So a little bit more interest in some of the university startups for 2021. And then for Series A, sort of early VC rounds, those can range anywhere from, I mean, it could be as low as 10. The typical is used to be 25, and now they go up to 50 million. 50 million would be sort of on the higher end, but still not the highest we saw in 2020. And so the mean that we saw from the PitchBook data is in the 40 million range for A's. And then when you look at devices, the numbers tend to be a little lower. For some of the pre-seeds and seeds, they are still kind of hovering around like the 2 million to 3 million range. But then when you go to the A's, it goes from, I'd say like an 8 million to like a $15 million Series A for a device company is pretty normal. And the diagnostics kind of follow a similar route, as well as some of the R&D tools. So
we can also follow up with the attendees with some of the data that we pulled on this afterwards when we send out the slides as well. So, but yeah, thanks to Nabil for quickly doing that as well. And hopefully we answered that person's question then. And so sorry, Margalit, now we're going to head into the IPOs and SPAC.
Yeah, no, I want to make sure we covered that question.
Yes.
So as we mentioned, the exit environment changed in 2020 with a record number of public offerings at very high valuations. And university startups got to participate in that boom. The slide here covers all university life science startup IPO activity from January 2020 till June 2021 when we pulled the data. And there were 49 IPOs for university therapeutic startups, with several companies going public with early stage preclinical programs like Beam and Sana, doing very well in the public markets. So the total for therapeutics for IPOs was $7.8 billion raised. With regards to devices and diagnostics, the number of public university life science startups was there were 3 IPOs and a total of 335 million raised. So lower on the device and diagnostic sides when it comes to IPOs. However, the total number of IPOs completed for university life science startups was 52, and the total raised was 9 billion in capital. So this covers the time from January 2020 till now, comparing that to a similar time frame from June 2018 to December 2019, so sort of like a 1.5-year time frame. The total number of IPOs for university spinouts at that time was a little lower, it was 45, but the total capital was 3.6 billion. So comparing that to 9 billion, it's quite the increase. There's less than half the amount raised from 2020 till now. If you go to the next slide, just to highlight the public market activity that we were seeing in 2020, this slide graphically depicts the number of $1 billion plus M&As and public deals over the last 3 years for life science therapeutics companies for the sector at large. So this isn't just university spinouts. This is actually from the Silicon Valley Bank report. So on the top, you can see the number of companies attracting deals in the $1 billion plus range stayed pretty consistent from 2018 to 2020, while on the bottom, you can see the number of multi-billion-dollar public companies has steadily increased, with over 50 companies with $1 billion plus market caps that IPO'd in 2020. And if you just look at the total number of therapeutics companies that IPO'd in 2020, it was 84 compared to 50 in 2019. So there was just this huge public market boom that happened last year. And then Manny will take you through the tech IPO and SPAC market on the next slide.
Yeah, usually there's, I'd say, a less healthy activity less comparable healthy activity on the tech side compared to what's going on in the life science space. But this past year has actually been really interesting. 2020, as everyone knows, will probably go down as the year of the SPAC. And there have been a number of SPACs that came out of universities. Well more than the kind of average pace you might see of university tech spinouts having an IPO. And so this is not meant to cover M&As. This is really just talking about IPOs and SPACs. You start on the top left, I'd say 2020 was a really interesting year for research tools. I think research tools kind of fit in the middle ground between life science and tech. And we don't really have a specific viewpoint on which one it should be. We've seen it come out of all departments. And so we really just handle it as a team. But I'd say there's been a number of really exciting announcements in the industry where many of these companies in the top left, Berkeley Lights and 908, out of universities, had tremendously impressive IPOs, where they've really continued to grow after they've gone on the public market. driven by strong traction and revenue and really exciting products that have core technology underpinnings. And then, diving a little bit into what's been happening in the SPAC landscape, on the bottom in hardware, very rarely would you expect to see hardware companies being public at the stage that some of these startups are at. And the SPAC, phenomenon of 2020 has proven that the public markets are interested in those companies, that they want access to them in a way that I'd say was stronger than what the venture community has shown interest in. And so it'll be a really interesting few year, let's say, whether the venture community reflects that similar enthusiasm in their private investments. While I think the SPAC phenomenon is going to be a passing trend, it did show that the public appetite is there. And so if the public appetite is there, does it change the investor mindset of putting money into these companies when they're private? And so I think that's the exciting thing we should all be taking home away from the SPAC, SPACs that have happened in the past year. And we should be excited that many of the most interesting SPACs came out of university research. So it's something we're paying attention to. We've got a few companies that'll be moving into a public listing when they de-SPAC in a few months. And I think there'll be a few more that we'll track in the general industry too.
Great. We actually, Manny, we have a question for you, and we have another one for Margalit. For Manny on the SPACs, have early stage investors seen SPACs then as favorable exits for their portfolio companies overall?
I think from a pure numbers perspective, it's favorable. The companies are garnering valuations that would not be, that are probably 3 or 4 years ahead of where we had normally targeted it to them to be. And so in today's SPAC market, they are, having valuations that we would have wanted to them achieve at exit. And so it's been favorable in that sense. What I think is still too early to tell is the volatility that's already starting to show. Is it going to affect the ability for these companies to execute? And I think that comes down to leadership. Are the CEOs going to be able to ride through the noise and really focus on being cautious and efficient with the $500 million that they have in their war chest? And so I think overall, I'd say it's been favorable. And then I think we will see some volatility, however, in the share price, but all the companies still have a decent amount of capital to spend to ride through it.
Yeah, thanks, Manny. And Margalit, before I ask you your question, I did want to just let the audience know that in the chat box, there is a link to a survey. We really do appreciate you filling out these surveys. That's how we kind of figure out what we're going to be doing in the future, what we need to change. You give us great ideas for webinars all the time. So please do fill out this very short, I think it's a 5-question survey in there. And then Margalit, and right after this, we'll get on to our parting thoughts because we're almost out of time. For the IPOs, is the uptick in deal sizes similar regardless of the geographic location of the startup, or is it mostly concentrated on kind of the traditional tech and biotech hubs?
Yeah, so we actually used to talk about the general VC financing investment activity across the US, and we used to present a slide on that, but most of the activity really did kind of center around these biotech hubs, and that is what we're seeing, but I don't have data right now to really support that specific question to say whether the larger deals are really Boston and California or when there's just smaller deal sizes in the middle. I think that'd be a great one for us to follow up with and get some real data.
I think so too. We will do that. Okay, great. Thank you. All right. And so I know we wanted to move on to kind of your takeaways from this, and we're just about out of time. So for those of you who can stick with us for another minute or two, we'll let Margalit and Manny wrap up.
Yeah. So the 2020 overall, I'd say was a surprising year on many fronts. The recovery of the tech industry and the tech investment pace, as I mentioned, was really surprising and exciting to see. I think the life science industry just had almost no period of reduced activity at all, and they were exhausted in 2020, I'd say, with the deal pace that we saw. And I'd say, to you all at the universities, you all did a tremendous amount of work during COVID, and I think you all sensed this as well, whether it was from disclosures around COVID related technologies, or professors and researchers that wanted to start companies now that they had a little time to think about other things. It was a very busy year. I'd say medical devices still suffered a little bit, and that they didn't quite see the same upticks that the rest of the industry did. I think we're going to see 2021 be a banner year. It's looking like. So I think we should expect next year when we talk about this to be surprised about 2021, and maybe we'll try and unpack really what went on and why. From an exit perspective, the combination of SPACs for the kind of hard tech, deep tech industry and the continued boom in life science IPOs in 2020 created a great exit window for university startups, where the life science companies really continued down the path of using that as a fundraising event that does provide some liquidity, and the tech investors were able to use SPACs as a way to raise the type of rounds that some of the deep tech companies have historically never been able to get from private investors. And so I think our team's paying attention to these windows, these booms, and we're cautious because we are starting to see a decline in some of the activity in the SPAC market, and then also a little bit of a softening in the therapeutics IPO windows. So I think the takeaway message for you all is this is a time to meet with investors, bring them to your startups. Interest is growing in the space that's coming out of universities, and we're excited to be a part of it. And do let us know how we can be helpful, and we're happy to provide any other insights that you may be interested in from the data you saw here and follow up. So thank you for your time.
Yeah. Well, yeah, we really want to thank our audience always for joining us for these webinars. This is one that we mentioned that we've been giving now for a number of years. And each year, kind of the data is always so interesting to us. And so we're always really happy to share it with you. And we really like looking, obviously, at these trends with regards to the academic institution startups. And we learn a lot from it always as well. I want to thank Manny and Margalit so much for today, for being with us. I also want to thank Nabil and Bethany and Natasha, who also helped us, putting this presentation together. And then, of course, the audience. We really want to thank you. We, Osage University Partners, we could not do what we do without you. So thank you for being partners with us. If you do have any follow-up questions, I forgot to actually put up the last slide. This is how you can reach us. But always feel free to reach out to any of us, and we'll hopefully get the right answers to your questions to you. So thank you for joining us today. Thanks for sticking with us. And everyone, stay cool where you can. Take care, everyone. Bye-bye.
Thank you.
Thank you. Bye.